Hi everyone, it's Sarah O'Neill and Sue Mills here from the Mills team, and we're super excited. We have a really special guest with us today. We have Lawrence Raponi, who is the Vice President of Private Capital Markets at Equiton, which is a Canadian-owned private lending investment company. And we're really excited to sort of share a lot about this firm, what they do, what they help Canadian investors with, and really apropos because we've actually had a few seminars of late for our clients in investing in real estate, buying an additional property. And for some people, they just don't have that 20% down and really believe in real estate and want to invest more, but don't really know how to do it. And we learned about your firm, and we're super excited to hear more about it as well.
Thank you guys for having me. It's nice to be here with you guys today.
Oh, great. Well, thank you. So do you want to start by just telling us a little bit about your firm and your vision?
I'd be happy to.
Yeah.
So we can sort of look at Equiton and break it down into who we are and what we do and how we do it.
Right.
Okay. So who are we and what do we do? Well, we offer thousands of Canadians opportunities to invest in real estate passively. Right. So you can take part in an asset class that you know and understand. It's going to be very stable. It's going to provide very consistent cash flow for you, but without any of the downsides or the impediments to physical real estate ownership, right? Which in my conversations with people is generally coming up with that big down payment, which you mentioned earlier,
right,
but also obtaining financing. And then let's just say you can satisfy both of those requirements. You now need to effectively be a landlord, right? You now need to manage this property on the day-to-day. For many of my clients, they either can't find the financing or don't want to put a huge down payment on the property,
right,
or maybe they can do both of those things. They just don't want a part-time job, right? Maybe they're approaching retirement. They're trying to simplify their life and not complicate it further. Maybe they have multiple kids at home, and for whatever reason, they just don't want that incremental responsibility.
And one thing that's kind of interesting is that our clients would tend to, if they're looking at a second property, would tend to be, maybe a single family home with a basement apartment or a condo they would rent out. But your type of investing in real estate is a little bit different, right? Because
That's right. It's what we call a passive real estate investment. So you're really leaving it at the experts at Equiton to oversee these projects and properties, acquire the right properties at the right valuations, and you're taking part in the capital appreciation of these assets and in the cash flows that they generate. But you take that backseat. You're leaving the active management of these assets to the professionals that have experience doing this and a track record of success. And you're free to go about your business as you would with any other type of passive investment.
And what types of properties do you tend to invest in?
Yeah, so that's more a question about the types of investments we offer, because we break down our investments into different strategies, right? And the idea here is that we have something for every type of investor. If you have maybe a long-term growth time horizon, we have an investment for you. If you're maybe more conservative and you want passive income, as an example, we also have investment vehicles that satisfy that strategy. So we have two different styles of investments at Equiton, and they're both passive. On the one hand, we have investment funds. Now, a single investment in either fund is going to give you that diversified or fractional ownership across a whole portfolio of properties, right?
Okay.
So a single investment in the fund is going to mean that you share in the profitability of a whole portfolio of properties, right? Now, on the other side of the spectrum, we have our development investments. Now, this is a direct investment into a land development opportunity. So these types of investments, they actually don't produce cash flow and they're not diversified. It's a direct investment into one project, but you're rewarded upon completion of that development with some very, very substantial returns.
Okay.
Yeah.
And those types of, as you say, those types of properties tend to be like either big residential
Exactly.
rental
In most
properties.
cases, we're building it's medium density or high density residential. So for your audience, we're building a condo essentially,
Okay.
and that's what the project we have today on offer is as well. One of the benefits of our investments that I didn't maybe mention off the cuff is the fact that these investments can be held in investment accounts, right? A lot of investors have a bunch of capital in accounts like TFSAs, RRSPs, or maybe a lira from an old employer that they left 2 decades ago.
Right.
It's very common for our investors to use these types of tax-exempt vehicles to make these types of passive real estate investments. And it makes sense for a ton of people because if you want to be in real estate, you can't exactly take money from your lira and buy a pre-construction condo, right? But you can get exposure to this asset class in a very safe way through investments like Equiton's.
So that's a really key word there, safe way. So just, backing up a little bit, because a lot of our clients like us, we didn't know that much about the sort of private lending opportunities in real estate. Can you sort of talk to us about how you're, legislated? We all watched the Bernie Madoff Netflix
We're all terrified
special,
now to invest in anything.
and so can you sort of back up a little bit and give us a bit of the sort of size and scope and how you're regulated?
Certainly. So we are a private real estate investment firm, and in our industry, private simply means we're not publicly traded. So we're not like a stock you can buy on the stock exchange. But for us, that is actually a benefit. We love being private. And the reason has to do with how these public investments are priced. So if any of your members of your network have stocks as investments or mutual funds, they'll know that the value of that investment is actually determined by the market itself, right? You have these traders that are trading on the Toronto Stock Exchange day by day, and through their trades, they're determining the price of an investment. Private investments like Equitons are not determined. The value of their investment, is not determined by this market of buyers and sellers, which we all know can be quite volatile. The pricing behavior of an Equiton investment actually behaves much more similarly to physical real estate. And the reason for that is because the value of our investments is determined by appraisals. So all of our buildings are actually appraised quarterly, and it is these quarterly appraisals that dictates the investment's value. And so you're left with an investment that has the flexibility of a stock. It can be held in a TFSA or RRSP. You can buy it in much, much smaller amounts, but it has the stability of physical real estate ownership.
So as you get more investors, does it actually dilute the pool of?
No, it's a very common question though. So once we take in capital from investors, our mandate is to put that capital to work. So let's say we raise $5 million from clients. Well, what we'll do is we'll go and buy another apartment building or another commercial plaza or whatever the mandate of the particular investment is. So there is no dilutive effect, because as long as we're employing that capital, putting it to good use, it's earning a return for clients. The pie actually gets bigger for everybody, because that investor that bought into one of our funds 3 years ago when we only had 4 buildings now gets to share in the profitability of the additional 7 that we had purchased since then. Okay. And so as the pie gets bigger for everyone, the diversification that allows for lowers the risk for the whole group.
And do you tend to buy properties? Sorry, we're both actually quite interested. Sorry. Do you tend to buy properties and hold them, and if you do, like obviously investment over time is going to grow in value. Do you tend to hold those investments, but then then again, how do you get the return for the clients if you hold them and don't sell them, or is it actually in the management of these properties that generates the revenue?
So it's a little bit of both. That's a great question, by the way. It's one of the first questions I always get. So let's take a step back, because I heard you mention private lending a little bit at the beginning. We are a private equity firm for the most part. Right. So an investor's capital goes towards the physical ownership of the building, which means they're an owner. As that building appreciates in value, they're going to share in that profitability. We're not taking loans from folks. We're not paying them an interest rate as a return. So they are owning these buildings. Now, in terms of how we generate profits, it's actually the same as physical real estate ownership. This is what I always educate my clients on. So let's say you're looking to do a real estate investment. You go out and you buy a duplex, right? You're going to see value in that duplex largely in 2 main ways. You're going to see capital appreciation of the building itself, and you're also going to realize a cash flow coming off of that property, because hopefully you have tenants in there and they're paying you on the first of every month, I would think. Now, with our long-term buy and hold strategies on the funds, they're going to be the same, right? We're going to go out and acquire, let's say, an apartment building. We're going to manage it 100% internally. We have our own in-house team of property managers that does this for our investors. And our mandate is to maximize not only the value of the building itself, but the amount of cash flows it generates. So as the appreciation occurs on the building, it's worth more and more over time. We raise the unit price of the fund, which reflects in terms of market value to our investors. So their investment grows. While that's happening, we have our tenants in this massive apartment building we bought paying us rent on the first of every month. That cash flow is actually turned and distributed to our investors. So these are cash flow producing investments. Again, it's meant to mimic physical real estate ownership, right?
And can you give us some examples of the returns that you typically, your clients certainly actually see?
So the fund I've been sort of powwowing with you guys on is the residential fund. It's our bread and butter fund. It's our largest and our oldest fund. It is a long-term buy and hold strategy on residential real estate. Okay. Now this fund's targeted return is 8 to 12%. So of that 8 to 12 that we target, there is a capital appreciation component and there's a cash flow component. Now, both of our funds that we offer at Equiton, we have two funds, they both pay 6% cash yields. Okay, so it's a very competitive cash yield and it's distributed on a monthly basis. And the reason for that is simple. Again, we want it to be the same as physical real estate ownership, right? So if a member of your network went out and bought a duplex, they're going to receive monthly cash flows from rent. They're also going to receive monthly cash flows from us the exact same way.
Okay. Interesting. And can you just go back just one step around the securities and how you're regulated a little bit?
Yeah, certainly.
Because it's a bit unique from typically dealing with a bank.
I started talking about how we're a private firm, and then I got segued, which happens a lot.
Yeah.
So we are a private firm, but that doesn't mean we're not regulated.
Okay.
Right? So we are regulated by the Ontario Securities Commission, both at the firm level, but also at the individual level. So I am licensed to raise capital for these types of private investments. We call them prospectus exempt securities, right? Just fancy words of saying a private investment. So I'm held personally accountable, as is the firm. But more importantly, how these funds are managed is what your investors need to know. These funds have independent boards of directors. Independent meaning the majority of the board, there's 5 on each board. They don't work at Equiton. They're not employed by our company. They are members of the public at large. They're real estate lawyers. They're real estate professionals in academia. They're very prominent brokers of different types. But these are the gentlemen and ladies that are responsible for presiding over the fund. So the types of decisions these people make are the main decisions for the fund. Should we buy property XYZ? Should we refinance that apartment building we bought 4 years ago? Should we dispose of that old Kingston apartment building, right? These are the types of decisions that the board of directors makes. And they're independent such that their responsibility isn't to us. They don't care whether or not we succeed or fail. Their mandate is to protect the investor, right? Are we acting in the best interest of our clients?
And I suppose as their kind of monthly annual reporting that actually goes to
Absolutely. I would say, although we're a private firm and we're not beholden to quarterly reports like Microsoft or Tesla or something like that, we do provide quarterly updates to our investors. So we issue quarterly reports on the fund's performance. And in those reports, you're going to see a bunch of financial statements letting you know the financial performance, but also have we acquired any assets this quarter? What is our outlook for the next year or the next quarter or whatever the case may be? And these are distributed to investors via our private investor portal. So just like any online banking platform, we have an online investor portal where folks can log in, they can review the market value of their investments, they can access any tax documents, any statements. And of course, if they're not finding the answers to their questions via the portal, they have a direct dedicated representative. So I personally manage a portfolio of about 250 clients. They call me all the time to discuss all things real estate, Equiton or otherwise. They want to know my opinion on the rising interest rate environment, what's our outlook for 2023, or maybe it's just a simple RRSP top-up. But I'm there as a source of information for them. And
maybe
to make
you
sure
can
that
actually just give us a scope of like how many investors do you have? What's the value of the portfolio? How many buildings do you have?
For sure. Perhaps we should have touched on that at the beginning. We manage over 890 million worth of properties, and we have over 8,000 investors at Equiton. We also have institutional investors. So these are firms like pension funds, university endowments that invest very large sums of money with us on behalf of their constituents. And we're a team of about 150 people in total. Okay.
And why haven't we heard, like both Sue and I were saying, like we didn't know about this opportunity, and which is why we're so excited to bring it to our clients today. But why don't we know? And I think the average consumer, I'm sure, doesn't know either. So why is that?
That's true. I think I would kind of blame the media for that. The media has a vested interest in giving financial information based on who pays their bills. And many oftentimes, especially in Canada, we live in a financial environment dominated by the big 5 banks. That's the reality here. And these big 5 banks have a vested interest in pushing their investment products. Now, that's not to say whether or not they're good or bad. That's really irrelevant. But what you do see is a very symmetrical or very common offering to everybody. All mutual funds kind of operate the same way. They kind of all perform the same way. It's a very bland kind of one-stop shop for everybody. there isn't a lot of room for alternative investments like ours to really get our head up and get noticed.
Right.
And so most of my time spent with clients is on the education, just letting people know that these investments do exist for people. There are some very high and powerful institutions that take advantage of these investments. And if they're doing it, then why aren't the individual investors like us?
Exactly. Right? And just to recap, go back a little bit. I mean, we love the residential fund. I mean, we'd like to hear about the other funds that you have as well. But we're big believers of, buy and hold strategy as well. And so when you talk about sort of that 8 to 10% return, if we look over the, sort of the last 40 years, the Toronto Real Estate Board, the market's kind of gone up, roughly about 7% a year. So it's sort of in line with that, I guess.
Yep, that's exactly right.
And is that in terms of like a 10-year average, would that 8 to 10% return hold,
Certainly.
even with the volatility of the market
Certainly.
over those years?
So specific to the residential fund, we target that 8 to 12.
Okay.
I like to say to clients, on average, you're going to get 10% a year. Now, that is going to be more or less in line with some other investments out there. But where Equiton really separates itself is on downside protection. We offer a very competitive return, but we have an investment here that has literally never dropped in value. We've been doing this for 7 years, since 2015. Right. No investment at Equiton has ever dropped in value.
So even like in 2017 when the world was falling apart?
No. And the reason largely has to do with the strategy we're employing in the residential fund. It is what we call a value add strategy. So we are acquiring assets that aren't currently optimized, right? Maybe we identify a potential acquisition target. It's an apartment building. The current owner operator isn't very savvy. They may have just inherited from their grandfather, whatever the case may be, but the building isn't being run professionally. Maybe some tenants are in there and they've been on very old legacy rental agreements. And as a result, they're paying below market rent. Maybe the building is in dire need of capital expenditure, some renovations. And so as a result, they can't charge as much rent as they would like. But for whatever reason, this building is underperforming. Now, for us, this is an opportunity because we can acquire this type of asset at a very attractive valuation. And then our in-house team of property managers can get to work and through the active management of this property, derive value from it. And in doing so, capturing it for our investors. Now, why is this important? Particularly because you brought up 2017. With this strategy, you're able to generate returns agnostic of what the overall market is doing. Right? If I can increase the value of a property through professional management, through renovations, through the installation of higher efficiency appliances, through increasing the landscaping, whatever I can do, well, that property is worth more. And it's worth more whether interest rates are at 0.25 or whether interest rates are at 4%. Right? And so we have taken the speculation out of the market. Right? We have the power to derive profits for our investors as opposed to just following the broader market.
And it's interesting in a way when the economy is in trouble, often people become renters. So in some ways, in a down economy, your product might even be stronger because you have and I assume immigration, as long as immigration continues the way it's supposed to over the next several years, that it should provide.
You hit the nail on the head, and that very thought, this idea of immigration, net migration flow into the country, that is really underpinning our investment thesis. We know that even today, assuming no immigration comes, there's a drastic undersupply of housing in Canada, right? Particularly in Ontario. With this new mandate from the Trudeau government to let in 1.5 million net new immigrants over a 3-year period, that number is not going to get better.
Right.
It's going to get worse. Right. And so fundamentally, our thesis hasn't changed. And that is irrespective of where interest rates are at. Right?
And the other thing that's interesting too is that because you can take over existing buildings, because the problem is it's hard to create supply because it takes so long to build. I mean, that's your land side of it, but the fact that you could just take over an existing apartment building, that's
exactly. And there's just a lot of opportunity in these buildings, right? Oftentimes the best locations have older buildings in them, right? They're just, in other words, if you buy a brand new building, it's probably going to be on the outskirts of some type of urban boundary. Why? Because all of the existing development would have happened years back in the major urban centers. And so there's a lot of opportunity to optimize these buildings that are in fantastic locations with very good proximity to transit, but just have some old tenants in there, maybe some tired looking lobby areas. And it's not too dissimilar of a strategy that a retail investor would employ, right? A real estate investor might buy an old bungalow and repurpose it into a duplex, right? They're finding creative ways to generate value in the property. And if they can do that effectively, they'll actually make money regardless of whether or not the market's up or down. We're doing the exact same thing, just on a much, much larger scale as professionals.
And can I just return for 1 second to the the nitty gritty of the actual investment? So, so let's say, what's the minimum investment somebody could
Great question. So we have 3 different minimums for our 3 different investments. We have 2 investment funds. One is called the Residential Income Fund, and it's the one largely we've been discussing today. We also have a second fund called the Income and Development Fund. And just like the name says, it has some income producing assets, some real estate developments, which really provide that high growth. The minimum for the residential fund is $10,000. The minimum for the Income and Development Fund is $5,000. Now, next to the funds, we have our standalone development investments, right? And this is not a fund structure. It doesn't produce cash flow, but it does have very high growth coming from the physical construction of a real estate asset. These minimums are $25,000. Okay.
And if you're, sorry, one more question, then I'll, so if you're saying it's been kind of a guaranteed 6% cash a year, if somebody wanted, if it's within an RRSP, for example, if somebody isn't planning to take out that money anyways, can that 6% just get reinvested?
That's right. So depending on who I'm working with and what their account of choice is, whether it's our RRSP or cash, we have a distribution reinvestment plan. Because of course, we're not going to automatically deregister or withdraw those monthly cash distributions. It needs to stay in the account. So we'll roll it back into the fund to automatically purchase more units month after month after month. And with compounding effects, the investment really starts to grow substantially.
Right. However, if someone wants to pull their money out, can they?
Yes. So that's the really big important question. It's one of liquidity. So everyone can redeem investments within 30 days at Equiton. Okay. So our 2 funds can be redeemed at any time with 30 days notice from the 15th of the month onward. So if you gave me a call on March 15th and said, Lawrence, I want to redeem my investment, April 15th, we're sending you a check in the mail. That's how it works. However, we are long-term investors, right? We are acquiring and managing properties for the long term. And truthfully, we've actually never sold a property at Equiton. So we need our investors to understand that these are long-term commitments. And the way we ask that of our investors is by asking for a commitment of a 5-year term. Okay. Now, I chose my words carefully. It is a request. Meaning you can sell at any time, of course. But if you redeem your investment before 5 years, there are early redemption fees to be paid to Equiton. And this isn't a source of profit for us. We don't do this to make money. We do it to incentivize a 5-year commitment. Because again, we're not flipping properties on the day-to-day. When someone makes an investment, we need to be confident that we can go out and buy that $20 million apartment building. And if you might call your investment back in a year or 6 months, well, that creates a risk not only for us at Equiton, but for our 8,000 investors as well. Right.
So that would probably, depending on the age of somebody, that may determine, do they do it within an RRSP or do they just do it as a cash investment?
And that's part of the service I would provide. So part of my education when I'm doing a consultation with a client is learning more about them. Before we talk about Equiton or real estate, I'm getting a better sense of who I'm speaking to. How old are you? Are you married? Do you have a family? Are you looking to invest in a TFSA or RRSP? What's your investment strategy? Do you own real estate currently? These are very, very common questions that come up, right? And based on who I'm speaking with and their needs and desires, we can come up with a game plan that makes sense for them today, but also in the future, right?
So if someone's got funds in an RSP right now and it's doing whatever it's doing and they're interested in, because you mentioned they can, transfer those funds over to Equiton.
That's right.
What do they have to pay tax on that when they transfer it? How does that work?
The whole process is actually very, very simple.
Okay, good.
It's a little bit of paperwork, but everything is actually done by the professionals at Equiton. So we are setting up the appropriate accounts for clients. We are requesting the necessary transfers from one RRSP to the next to make the process as simple as possible. Aside from signing a few documents, there's really nothing that the client needs to do.
That was really interesting. I agree. I think we could go on forever. Maybe in light of this webinar, we might have some clients who want to reach out and learn more. Certainly, if you do, definitely feel free to send us an email to team@themillsteam.ca, and we can definitely set up either a one-on-one meeting with Lawrence, or maybe even arrange another webinar where we invite clients to come in and have you present and
Absolutely.
spend a good hour talking, I'm sure, or more perhaps.
Probably more.
I was looking at our questions. I don't think we actually got through them all.
I literally didn't even open it.
Yeah, exactly. I didn't either. But that was fantastic. Really
Thank you guys very much.
informative.
And it was a pleasure being here with the two of you today.
Oh, thank you so much. And again, thanks for joining us today. And don't forget, if you'd like more information, feel free to email the team and we'll get right back to you.